Hello and welcome to Construction Week's expert interview series, where we continue to speak to experts within the construction, infrastructure, and real estate sectors. Joining us today is Sapna Jagtiani, the director at credit rating agency S&P Global Ratings, a division of S&P Global that publishes financial research and analysis on bonds and commodities. To start off, Sapna, thank you for joining us on the show today.
Thank you. It's a pleasure.
It's a pleasure to have you here with us, Sapna. While on one hand, COVID-19 has brought about mobility restrictions and impacted the sector, on the other hand, some analysts point to the slowdown in the construction as a blessing in disguise. Given that Dubai real estate has been coping with a supply glut and a heavy pipeline of properties, how do you think that COVID-19 will affect the supply and demand curve in Dubai's residential real estate market?
Right. So I think we should approach supply from two angles. So one is the pre-sold, under construction angle, which you've been talking about, and the other one is new launches. So the under construction properties, we have seen some delays. Some construction activity was paused due to movement restrictions. Many were slowed down in order to maintain social distancing, etc. But overall, since a lot of these properties are pre-sold, these are just temporary delays and units will eventually be delivered, adding to the supply glut. There may be some cancellation of projects, but these will not be very significant. The good news is on the new launches that have slowed down significantly, almost dried up, in fact, especially during the lockdown phase and even after, due to the travel restrictions. Sales to international buyers has not been very easy. And so therefore, developers are now focused on selling existing inventory to ensure that there's a buyer behind every unit that they're constructing, tightening their payment plans, so collecting as much payment as possible to secure their own cash flows rather than launching new products or new projects. So with more than 100,000 units still to be delivered over the next 12 months to 24 months, presumably largely pre-sold and therefore will be built and delivered, any meaningful halt to supply will probably be post-2022.
Which then brings us to our million-dollar question. When do you expect the Dubai residential real estate market to bottom out?
You're right, it's worth $1 million and a very difficult question to answer. But we look at a lot of real estate research that comes out of real estate houses. And I think the consensus is that on an average, residential prices have declined about 11% from the start of the year versus last year, Now, at S&P, we think that there's more downside on residential prices, especially in the secondary market. As more supply comes in 2020 and 2021, which will make it harder even for developers to sell in the primary market. So therefore, we believe until the structural oversupply issues are managed, let's say by 2022, we may not see price stabilization.
Could you share your insights on how project funding and capital funding could change?
The key lenders to the real estate players continue to be the banks. And although credit is less available than before, let's say, but the GCC banks are still able to support blue chip names with comfortable pricing, good maturity schedules, and even rollover debt if necessary. The government has been extremely supportive. They rolled out several measures to support the sector, and key amongst them was to raise the maximum exposure of banks that the banks can have to UAE real estate, so which went from 20% to 30%, and some other LTV provisions as well that were relaxed. And all of these were aimed to help ease liquidity pressure on our developers and the sector as a whole, and to maintain the investment in the sector despite the economic impact of COVID-19. But I think for highly rated companies, we expect the bond market will in fact remain supportive.
Do you think that the performance of major developers are likely to take a hit in Q3 and Q4 as we come to the close of 2020?
Yeah, I mean, we expect property developers to see lower pre-sales, as we discussed before. We expect increased pressure for discounts, other incentives, slower cash collections, backlog contraction, pricing pressure, and even soft demand, particularly for international investors, which account for a lot of the sales, more than half almost. We will also see higher delinquencies. I mean, it's possible a number of deferral of customer payments than we've seen historically ever before. And so for developers, the focus will be on cost reduction measures, capex deferrals, completing and selling existing inventory, which will allow them to cash in large post-handover payments. You saw Q2 results already for a number of developers, and they were quite weak despite them having a very good head start. So Q1 was quite decent for many of them. But at S&P, we expect that 2020 will actually be a trough year, and the pressure on developers' revenue and profit will continue.
What's your message to investors and stakeholders interested in Dubai real estate? Is there a ray of hope for a better tomorrow?
Look, as I mentioned before, we have a fairly grim view. We expect the drop in prices to be steeper, despite the second half. We are seeing lower movement restrictions. We believe the price declines will linger well into 2021, and the negative employment trends, lower purchasing power, etc., they will weigh on demand for new properties. And therefore, we expect developers to intensify their offers and incentives on new property sales, whether they're rent-to-own schemes or cash rebates or waivers on service fees and maintenance fees, etc. So we believe the recovery process will be long. It will be very slow. And at the moment, it's quite uncertain whether the World Expo 21 can shore up market sentiment or lead to a meaningful recovery in Dubai.
Thank you for sharing your insights with us today, Sapna. It was great having you on the show. For those of you watching, feel free to like, comment, share, and subscribe for more such videos with experts in the industry. That's all for now, and until next time, goodbye.